On the morning of January 12, 1994, millions of people across West Africa woke up to find their life savings had been cut in half. Literally, overnight. There were no tanks in the streets, no stock market crash. The devastation did not come from a war but from a signature on a document, signed thousands of miles away in a quiet, sterile boardroom in Paris. History calls this a failure of the system. History is wrong. This was the system working exactly as it was designed to. We tend to view these events as distant anomalies, tragic stories from emerging markets. But the architecture of debt, external control, and sudden devaluation used that day is the same blueprint underpinning the modern global economy. We are not here to mourn a tragedy, we are here to study the design. December 26, 1945. The smoke had barely cleared from the battlefields of World War II. Europe was in ruins. The United Nations was being born. The entire world was drunk on the promise of a new era of freedom. But in Paris, a different kind of document was being signed. One that had nothing to do with freedom, and everything to do with leverage. On that quiet day after Christmas, the French government created the CFA franc. The official press release called it an act of benevolent cooperation to help its African territories develop. But if you strip away the diplomatic language and look at the raw economics, the intent was forensic in its precision. France, devastated by war, needed two things desperately. One, a guaranteed supply of raw materials without burning its own fragile foreign reserves. Two, a captive market where no one else could compete. They did not need an army to secure this. They just needed a currency. In the corporate world, if you force a supplier to sell only to you at a price you dictate, it is called a cartel. In 1945, the architects of this system simply called it monetary stability. This architecture was so robust that it survived the one thing designed to kill it: independence. Fast forward 15 years, the 1960s. The wind of change is blowing through Africa. One by one, nations declare their sovereignty. The flags change colors. The national anthems are rewritten. The presidents are now local men delivering passionate speeches about self-determination. But look closely at the money in their pockets. It remained exactly the same. This is the great paradox that confuses historians, but makes perfect sense to bankers. Why would newly free nations voluntarily keep the currency of their colonizer? Because the chains came with a warranty. The local elites, fearful of the political instability that often follows revolution, made a calculation. They chose safety over sovereignty. France offered a seductively simple deal. We will guarantee your money. We will ensure it is always convertible. You will never face hyperinflation. It sounded like a shield. In reality, it was a ceiling. By accepting this protection, these nations agreed to a monetary framework that was not designed for their development, but for Europe's recovery. They handed over the keys to their economic engine before they had even turned it on. It was a brilliant stroke of structural engineering. The system appeared technical. It appeared neutral. It appeared boring. That was the point. You do not question what bores you. But a currency is just a symbol. To understand how the control actually physically works, you have to look at where the money goes. And that leads us to the most controversial and carefully guarded clause in the entire agreement. If the foundation is rigged, let us look at the vault where the money is kept. Imagine a bank that requires you to deposit your entire paycheck into their vault before you are allowed to spend a single dime. Now imagine that same bank tells you that for safety reasons you are permanently forbidden from accessing half of that deposit. You can look at the balance on a screen, you can call it yours, but you cannot touch it. This is not a hypothetical scenario. This is the operating manual of the CFA franc. It is called the operating account mechanism. Under the rules of this monetary union, member nations were historically required to deposit 65% of their foreign reserves directly into the French treasury. Today that number has been adjusted to 50%, but the principle remains absolute. Note the destination. These billions of dollars in oil, cocoa, and gold revenues do not go to a neutral international body like the IMF or the World Bank. They go to the national treasury of a former colonial power. This creates a financial anomaly that is almost impossible to explain in a standard economics class. Developing nations, hungry for capital to build roads and hospitals, are effectively lending their cash reserves to a G7 nation at negative real interest rates. They are funding the deficit of their guarantor. The defenders of the system call this fiscal discipline. They argue it prevents corruption and reckless spending, and on the surface a disciplined budget sounds responsible, but in the brutal reality of global economics, discipline is often just a code word for paralysis. Consider what happens when a crisis hits. When the financial crash of 2008 struck, or when the pandemic shut down the world in 2020, what did the United States, Europe, and China do? They printed money. They launched massive stimulus packages. They used counter-cyclical policies to save their industries and feed their citizens. The CFA nations could not, because their reserves were locked away and their central banks were handcuffed by strict limits on direct financing. They were stripped of the ability to stimulate their own economies. While the rest of the world fought the fire with a fire hose, these nations were handed a cup of water and told to wait for rain. The system forces them into pro-cyclical policies. This means that exactly when their economy is shrinking and their people are suffering, the government is forced to cut spending and raise taxes to maintain the reserve ratios required by Paris. It creates a perfect trap. The poorer you get, the less you are allowed to spend to save yourself. If you run out of liquidity, you do not get your own money back automatically. You have to borrow, and often you end up borrowing from the very entity holding your reserves, paying interest on money that was yours to begin with. They call this stability. To the forensic accountant, it looks a lot like paying your boss for the privilege of working for him. But the vault is just the storage. The handcuffs are just the restraint. The real theft of potential does not happen in the dark of a bank vault. It happens in broad daylight, flashing on every trading screen in the world. The exchange rate. If you ask a politician what kind of currency they want, they will almost always say, a strong one. It sounds patriotic, it sounds powerful, but in the mechanics of global trade, a strong currency for a developing nation is not a badge of honor. It is a death sentence. This brings us to the second pillar of the system, the fixed peg. For decades, the CFA franc was pegged to the French franc. Today it is pegged to the euro. The exchange rate is fixed. It does not float based on the performance of the African economies. It floats based on the performance of Germany and France. Here is the problem. The euro is designed for highly industrialized, high-productivity economies. It is a heavy currency. When you strap a developing agrarian economy to a heavy currency, you create a catastrophic distortion. Think about the cotton farmer in Mali, or the cocoa grower in Ivory Coast. Because their local currency is artificially strong, their crops become expensive on the global market. They struggle to compete with farmers in Asia or South America whose currencies are weaker. They lose market share, their income shrinks, but the real damage is not in what they sell, it is in what they buy. An artificially strong currency makes imports artificially cheap. Suddenly it is cheaper to import tomato paste from Italy than to build a factory to process tomatoes in Senegal. It is cheaper to buy furniture from China than to develop a local timber industry. This is the export trap. The system effectively subsidizes foreign factories while suffocating local ones. It makes industrialization mathematically impossible. An entrepreneur in Dakar cannot compete when the monetary system itself gives a 20% discount to his foreign competitor. So the economy remains frozen in time. They export raw materials like logs, oil, and beans at rock-bottom prices. And they import finished goods like tables, gasoline, and chocolate at a premium. They sell the wood and buy back the furniture. They sell the crude and buy back the fuel. This mechanism ensures that value is never added inside the country. It is always added outside, in the factories of the partner nations. And who benefits? The urban elite, the politicians and civil servants living in the capital. For them, the strong currency is a blessing. It allows them to buy imported cars, French wine, and luxury electronics at affordable prices. It is a perverse form of redistribution. The system acts as a massive subsidy for the consumption of the rich, paid for by the destruction of the productivity of the poor. In any other context, this would be economic suicide. No independent nation would voluntarily choose a currency that makes its own products too expensive to sell. So why does it persist? Why do the local economists, the central bankers, and the finance ministers defend a system that keeps their nations deindustrialized? Surely they can read the same balance sheets we can. Unless, of course, they are reading from a different textbook entirely. The most effective way to control a nation is not by occupying its land. It is by occupying the minds of its accountants. If you walk into the headquarters of the Central Bank of West African states, you will not find radical revolutionaries or anti-colonial thinkers. You will find brilliant, well-dressed technocrats. Many of them were educated at the finest universities in France. They speak the same academic language as the bankers in Frankfurt or Paris because they were taught from the same textbooks. This is what scholars call institutional mimicry. It is the practice of adopting the frameworks, models, and goals of a foreign superpower, regardless of whether they fit the domestic reality. The European Central Bank has one primary obsession: price stability. It is designed for aging, wealthy, industrialized nations that fear inflation above all else. But the nations of the CFA Union are young, developing, and desperate for expansion. They do not need a central bank that acts as an inflation hawk. They need one that acts as a growth engine. Yet, because of this mimicry, the local central bank enforces the exact same rigid policies as Europe. They keep interest rates high and credit tight to protect the currency. In doing so, they solve a problem they do not have, by sacrificing the growth they desperately need. There is a dry irony here. It is like insisting on wearing a heavy wool winter coat in the middle of the Sahara Desert, simply because that coat is currently the height of fashion in Paris. It looks professional, but the heat is killing you. This is not a conspiracy in the traditional sense. It is a culture. When a nation's technical elite is trained to view the world through the lens of their guarantor, they stop seeing the systemic handcuffs as a problem. They see them as standard practice. They become the defenders of the very system that limits their country's potential, convinced that any alternative would lead to chaos. Recent reforms have been announced, promising more autonomy and even a name change for the currency. But look at the fine print. The fixed exchange rate remains. The French guarantee remains. The mindset remains. It is a technocratic dependence that is almost impossible to break, because the people in charge of the tools are the ones most convinced of the tool's necessity. While these elites debate the technicalities of inflation targets and reserve ratios, the real-world consequences are mounting. Because when a country cannot grow its way out of trouble, it only has one other option to survive. While the economy suffocates under these rules, a new threat quietly builds up in the background. Debt. If you want to understand how a nation loses its future, do not look for a sudden catastrophe. Look for a boom that feels too good to be true. We have spent time in West Africa, but the mechanism of dependency is not a local phenomenon. It is a global pattern. Since 1970, the world has witnessed over 520 episodes of what economists call rapid debt accumulation across emerging markets. That is an average of more than 10 per year. It always begins with what we call the sugar rush. A government decides to accelerate growth. They borrow heavily from international markets to fund massive infrastructure projects, expand public services, or subsidize domestic consumption. For a while, the strategy appears brilliant. The skyline of the capital city changes, GDP numbers climb, the middle class expands. To the casual observer and to the international lenders, the nation looks like the next great success story. This phase typically lasts about 7 to 8 years. It is a period of collective amnesia, where everyone agrees to ignore the underlying math. But debt is not growth. It is simply future consumption brought into the present. In these 520 historical cases, roughly half ended in a full-scale financial crisis. A literal coin flip with the survival of a nation's economy. The dry irony is that the very debt meant to fuel the engine eventually becomes the sand that grinds it to a halt. When the boom ends, it does not just stop, it implodes. The currency collapses, the banking system freezes, and the miracle is revealed for what it was, a mirage built on credit. Statistics from the World Bank show that in these debt-driven crises, a country's GDP per capita ends up 6 to 10% lower after 8 years than if the boom had never happened. They do not just lose the progress they made, they fall further behind their starting point. The tragic reality is that this debt is rarely used for growth-enhancing investments. Instead, it is often funneled into populist policies or inefficient public spending, short-term fixes that buy political time but offer no long-term return. But a high debt-to-GDP ratio is only the surface of the problem. If you want to spot the exact moment the mirage will shatter, you have to look deeper than the total amount of money owed. The crash does not happen just because they borrowed. It happens because of how they borrowed. What turns a correction into a catastrophe? In the world of high finance, it usually comes down to two specific triggers that most people never see coming until it is too late. The first is what economists call original sin. It sounds theological, but it is purely mathematical. It refers to the inability of a developing nation to borrow in its own currency. Instead, they are forced to borrow in US dollars or euros. This means the country is essentially gambling on a variable they cannot control, the exchange rate. Imagine you take out a mortgage today, but the bank tells you the monthly payment will fluctuate based on the price of gold in Zurich. You have no control over the price, but you are legally obligated to pay the difference. That is original sin. The moment the US Federal Reserve raises interest rates, the local currency slides. Suddenly, the cost of servicing that debt explodes. Even if the government hasn't spent an extra penny, they enter a vicious cycle where they must borrow more just to pay the interest on what they already owe. But then comes the second trigger, the double whammy. History shows that a rise in government debt is dangerous, but it is manageable. However, when a government debt surge happens at the exact same time as a private debt surge, usually in real estate or corporate lending, the probability of a total currency collapse jumps to 24% in a single year. It is the financial equivalent of a perfect storm. Under a normal system, a country might devalue its currency to make its exports cheaper and earn its way out of the hole. But for nations trapped in a fixed-rate system like the CFA franc, that exit door is locked. Because they cannot adjust their interest rates or devalue their currency, they are effectively locked in a room with a ticking bomb. They are forced to wait for a guardian in Paris or Frankfurt to decide their fate. The dry irony is that the stability promised by these systems is exactly what prevents the country from surviving the shock. By the time the world notices the smoke, the foundation of the economy has already been liquidated. They call it aid when they lend you money to pay back the interest on the money they lent you last year. In reality, it is a foreclosure on the nation's future. And when the dust finally settles, the damage is not temporary. There is a comfortable lie told in mainstream finance that economies are resilient. We are taught that a crisis is just a dip in the chart, and that given enough time and enough structural reform, every nation eventually bounces back. The data suggests otherwise. When a debt-driven crisis shatters a developing nation, it does not just pause progress, it leaves a permanent scar on the country's DNA. Forensic analysis of these events reveals a pattern economists call the lost decade. 8 years after the initial crash, a nation's GDP per capita is typically 6 to 10% lower than if they had simply avoided the debt surge entirely. But the most chilling number is in the seeds of the future. Investment. Nearly a decade after the dust settles, investment levels remain 15 to 22% lower. The capital is gone. The trust is gone. The momentum of an entire generation is liquidated. In the case of the CFA franc, we see a cycle of reforms that change the branding while preserving the plumbing. In 2019, the currency was renamed the ECO. They promised to end the requirement of sending reserves to Paris. But look at the fine print. The fixed exchange rate to the euro remains. The guarantee by the French Treasury remains. The structural dependency is not removed. It is simply repainted. We are told these measures provide certainty for investors. But for the citizen on the ground, That certainty looks like a ceiling they can never break through. The crisis was not a glitch in the system, it was a reset. It was a massive transfer of wealth and sovereignty from the productive poor to the institutional creditors. When the chaos ends, the international banks have their interest. The guarantor nations have their stability. The poor stayed poor, the debt remained. This is the reality of a world built on monetary dependence. It creates a loop of vulnerability, where the solution to every crisis, more debt, more external oversight, only deepens the trap for the next generation. We look at these systems and we see a tragedy, but a tragedy is an accident. What we are looking at is an achievement of engineering. The question is not whether this architecture is flawed. The question is why it is so remarkably consistent. And that brings us to the final realization. We view these accounts, the CFA franc or the debt surges of emerging markets, as distant anomalies, relics of another time or another place. We tell ourselves these are stories about the failures of them. But look closer at the blueprint, a structure that prioritizes external stability over internal reality, a technocratic elite that mimics a foreign textbook while the street outside suffocates, a system where debt is used not to build but to mask a lack of production. It sounds uncomfortably familiar, does it not? We are taught to see these financial episodes as accidents, unfortunate glitches in the march of progress. But the forensic data suggests otherwise. These systems did not fail because they were broken. They failed the people because they were working with surgical efficiency for their architects. The question is not whether the system was rigged. The question is not whether the system was rigged, and who are the raw materials. Leave a 1 in the comments if you have begun to see the pattern. Subscribe to Financial Money History to decode the next chapter.